So this is a class on 50-day moving averages, 200-day moving averages, which are also known on a weekly chart as 10-week moving averages and 40-week moving averages. So let's explain that real quick. 50 days divided by 10 weeks, or 5 days a week, is 10 weeks. 200 days divided by approximately 5 days in a week is approximately 40 weeks. They're not exactly the same, but a 50-day moving average is pretty close to a 10-week moving average. This is a chart of a company called FleetCor. Now, FleetCor has been a nice performer since its IPO back in late 2010. And you'll notice that after its initial pop-up, it made a correction, a little bit of a shakeout, some sellers in there. But once it started to go higher, it pretty much hugged its 50-day moving average. Notice how it stayed above it for a long period of time, and it's still above it even to this day. When it hit below it, mutual funds generally stepped in, institutions, mutual funds, hedge funds, stepped in and continued to support that stock, giving it a really nice pattern on the chart. Now, the company had to do its work on its own. They had to increase their earnings and their sales and generally perform well as a company. But as it did it, notice how time and time again it bounced off that 10-week moving average on this chart. Also notice that there is a cross of that red line, the 50-day moving average, the 10-week, above the 40-week. And when that happened, and since that happened, that stock has gone up incredibly. So it's gone up from approximately $35 to more than $100, $110 where it is today. So if you watch these moving averages and you watch how they approach, how they break through, the kinds of volume, that's an important thing to see, because that tells you where the institutions are getting in. Institutions watch 50-day moving averages. Institutions watch 10-week moving averages. They also, secondarily, watch 40-week moving averages. That's that black line on that screen. You'll see the one time that you had a serious breach over the last couple of years of that 50-day, the institution stepped in and drove it right back up in that same week above the 50-day, or above the 10-week moving average. So they don't want to see their investments go down. So what they do is they step in, and when they find a buying opportunity, they keep buying more. Nothing's happened to the company in their view, so they look at it as a buying opportunity, not a selling opportunity. It's only when a stock starts to change its pattern that the mutual funds, the institutions, start to change their behavior because the stock's changing its behavior. So you want to watch that. But nothing really good happens to a stock unless it's over its 50-day moving average. And nothing bad will happen to a stock if it's over its 50-day moving average as well. On the downside, stocks will adhere to that 50-day moving average as well. And you'll see them bounce down time and again when that stock is just not healthy. And so that happens. The 200-day here that we're looking at has also been a support level. One time it did kind of come down. It had a little bit of trouble after it broke down through its 50-day moving average. There was some shakeout, some sellers. And when it did, the mutual funds backstopped it at that 40-week, that black line right there, and drove it back up. And then you see a big volume day there where institutions bought it, and from that point it's really been nothing but up since, almost every week. So that's a healthy looking stock. There are lots of other stocks and other patterns that you can look at. Looking at that cross where the red line goes through the 50, that is something we like to take a look at. We find that to be a really good indicator that a stock is about to make a run. There are other indicators as well, but notice how once that cross happens, you start to see a lot of really great performance from that point on. We're going to show you a couple of other charts here in a moment so you get an idea. Let's shift gears to another company you know of, which is Apple. Look at the chart on Apple. Now, you're going to see some good things here and some bad things, but notice how after that cross there at the beginning of the chart, you're going to see some great performance when it comes to the 50-day moving average. Very few times did it breach it and stay below it for very long. There's a big breach there, and notice how when it did that, it had a little bit of trouble, but once it got rid of that trouble, then it kept going higher. And once it did, it tried to stay above its 50-day moving average probably 3/4 of the weeks. And when it didn't, that was a time not to be in the stock because it wasn't going to perform. So it really touched both the 50 and the 200 right there where we're pointing. But again, the institutions didn't want to see their investment go down, so they all viewed that as a buying opportunity. And when they did, that was about $180, and the stock has done nothing but go up from there, even though it's had a major correction since then. It went up there. So that stock has gone up for, let's say, $120 all the way up to $700. And then it had a correction of about 30% since then. And notice it's below its 50-day moving average here. And there's not very much volume selling it, and then it drives right above its 50-day or its 10-week moving average again, and it stays above it for a long period of time. Now, when we start talking about chart patterns and bases, you're going to want to put that together with the 50-day moving average, the 10-week moving average, the 40-week moving average, and the way the stocks perform on those. But this is a really good way to start looking at stocks. Now notice how when Apple broke down here, it couldn't break above its 50. Once it finally broke down below, it couldn't break above it for a long period of time. And now we're looking at another what we call a golden cross, where the 10-week crosses the 40-week on the upper side. And we think Apple's got some positive prospects here in front of it for quite a while. It could be a little while before it develops, but we think that's going to happen. Nu Skin, another company that has done extremely well. Now, we don't love this pattern as much because if you'll notice, there's a lot of breaches of that 50. And it's not as healthy as some other companies that we like to stay above that 50, like that Fleetcor, or maybe even the Apple on its run. Once it goes down below those 50-day moving average, that 10-week moving average, you start seeing, and it's having a heck of a lot of trouble. And then when you have that golden cross, or that we call it a death cross, where the red line crosses the 50 in the middle of the chart, not a lot of good things happen on Nu Skin. Visa is a stock that we do like. And the way it performs is very exemplary of the way we like to look at 50-day moving average. This is called a chugger. Basically, just chugs along. And if you see as soon as you see that cross there of the 10-week above the 40, you see Visa by and large staying, I'd say probably 90% of the time above that 50-day. And then even now lately we've had a breach of it. It still has driven right back up. And the 200 hasn't even come into play. It came into play one time back in September of 11, and since then, that stock hasn't even come close to that 40-week moving average. That's a kind of a pattern that we like. Now, there are other patterns that are tougher to trade. They're a little bit tougher to predict. One of those is a company called Toll Brothers. And Toll Brothers was a home building company, and once it had its shakeout there, you can see that it performed pretty well, but there's some volatility all over that stock above its 50-day moving average, making it a lot harder to trade, especially lately. Look at the performance here, and it's very difficult to want to be in that stock because it moves a lot and it doesn't adhere and respect that 50-day or that 10-week moving average. In fact, right now, I would argue that it's not a buy because it's below its 40-week. 3D Systems, one of the great performers of 2012, you can see how well this stock does with respect to its 50-day moving average. You can just look at it and say, wow, most of the time when that stock trades above it, it goes higher. And when it doesn't, there's just shakeout going on, and you need to be careful. So not a lot of bad things happen above the 50-day moving average, but a stock will never go higher unless it is above it. So you'll see, as soon as that stock doesn't have the ability to stay above it, it shakes out a lot of people. And then once you get rid of those people, now you have a healthy stock again. You have your cross, it stays above the 50, it bounces off the 50, there's support there, and then there's a little bit of a breakdown, but it's on pretty low volume. And that's just normal shakeout, and those mutual funds will continue to drive it back up. Another shakeout, and now that stock has continued to respect that 10-week moving average. We think it's something that you should look at. You should watch the way the 50 days work. You should watch the way the 50-day works with the 200 and the 10-week moves with the 40, same basic thing, because that's what the mutual funds are looking at. And we don't want to try to beat the mutual funds. We want to join the mutual funds, and the moving averages are a great way to do that.